All right, folks, welcome back. This is our weekend review for the ICT Mentorship for July 24th, 2020. All right, so on the left-hand side, we have the dollar index, and I'm going to start with the lower time frames and work our way up. So right away, you can see that we had a run above the short-term high here and did not take out the high here on the 23rd. Okay, so you'll notice that the low on euro did take out that same low. So just for contrast, the 23rd at 1545 on the 23rd at 1545. So this high was not pierced by this high. So we have a lower high. While at the same time, we should have seen a higher low relative to this low and this low. This low should have been higher up, but there's a crack in correlation. This is SMT. Distribution, which one failed to make a higher high? This. So it's weak dollar. What's it going to reach for? A more meaningful protraction below the old low at 94.65. High, low in between, higher high, inside of the SMT. Okay, so SMT divergence is the low and lower low on euro, which should have been seen with a higher high here versus this high. But because it didn't do that, that's a crack in correlation. It shows there's underlying weakness in dollar. So if that's the case, we go into the marketplace and we look for things that would justify being a short. So in this case here, we can see a breaker. So it's the last down close candle right in here. And you can see the market moves below this low here and then comes right back up into this candle right there. The high on this candle comes in at 94.66 and the high on this candle comes in at 94.67. So it was only off by 1 pip, but still nonetheless it's very, very good reaction there. The lowest down close candle inside of the swing here and inside the swing low. So that is your breaker. That's your bearish breaker. And also trades right up into our old 94.65 old low, which makes it a premium array. Fair value gap, consequent encroachment. This candle's low. This candle's high. Midpoint, boom, hits it. We break down. We come back up in, rebalance right in here, immediate rebalance, and then goes lower and starts to just keep grinding lower. In euro, we had sell side liquidity pool here. The market breaks down, induces short selling, stops out anyone long. The market breaks higher during the New York Open, kill zone, which is 7. I have it to 10 o'clock in the morning in here, which is the beginning of the London close. So we have New York Open to London close, 7 to 10. That's what I have here on this chart. Stops have been taken. Once they've been purged, the algorithm will move higher, drops back down into consequent encroachment between this candle's low, this candle's high, midpoint, boom, hits it, rallies away, clears the relative equal highs, comes back in, fair value gap, rebalances, goes a little bit beyond that, and that's acceptable. Market rallies up again, keeps relative clean highs, trades back down to a bullish order block, rallies again, comes back down into order block, and then expands up going into the close of the week and the close of Friday. We have 1670, which was my target. I wanted to see that hit. I thought we were going to get a little bit of a late rally and drive up into that. I had my tweet all ready to go. So I'll have to defer that until Sunday or Monday. Hopefully we'll see that price trade to it. And then continuing higher up, we can see that weekly rejection block. And then the old weekly high coming in at 118.15. Now that's a lot of distance, and I'm not saying we're going to go there right away, but for a longer term perspective, if we stay weaker on the dollar, that's what I'm looking at. And it'll have to obviously tear higher aggressively in the dollar for me to change my stance on that. But we'll get what we get in by studying it. Now, you're probably asking yourself, what is this blue line here? That is the opening price for the 24th. And you can see price trades down. This is your Judas swing. This is market protraction, power of 3. So open, find liquidity. If you're bullish, trades down to it, and then starts to move higher. You can always capture these moves at least once per week if you understand the higher time frame. If you don't understand the higher time frame, these types of moves are going to be very difficult for you to see unless you can find them in hindsight. But it begins with having a bias. I have purposely stayed on euro dollar this entire month, avoiding cable, avoiding any other foreign currency to discuss other moves that were obviously there. But I want you to focus on one, because one currency pair is all you need. You don't need a slew of different markets to trade, because all it's going to do is thin your attention span. You want to be able to be dialed in, know what you're looking for. All these things occur on every currency, every market really. But if you're limiting your amount of focus by having so many markets, because you're thinking, especially as a new student, well, more currencies, more markets to watch, which means I'll be able to find a setup easier and more of them. Well, they're all going to basically be doing the same thing anyway. So if you could just keep your focus on one, you're more likely to find the setups that you're anticipating to find across a dozen. All right, so keep it simple. Keep a short list of things that you have to go through. And if you add 28 pairs, okay, of how do you watch that? I just can't grasp that. But then again, I have a short attention span, so maybe some of you in here can do exceptionally well doing that. I'm just going to tell you again, learn to do it with one currency pair. And then if you want, and if you're doing it well, then you can add one or two more as you get more proficient. But if it starts to affect your efficiency and your focus, then you have to dial back in the number of markets you're watching. All right, so same thing over here in this opposite terms. We have the opening price for the 24th, and the market runs up. This is your Judas swing, okay, and the market breaks down, then creates the bearish breaker, and everything is an opposite. What's going lower here sends price higher in euro. All right, so let's take a look at the hourly chart on both dollar on the left and euro on the right. You can see we had a nice consolidation. The manipulation is right here, the stop run here, and then SMT, which is a Kraken correlation. Again, the bias has been what, folks? Okay, it's been called lower on dollar. We wanted to see a more meaningful run below 94.65 because it's done it yesterday, but then we had the protraction lower there. And again, we have a rejection block on a weekly down here. It would be the next downside objective, 94.22, and then the old weekly low at 93.81. So we're going to see how we trade, if at all, down to that weekly rejection block. We're staying with the bias that is bearish dollar. We're not trying to capture the bottom. We're not trying to pick the bottom. We're not trying to be smarter than the market. Okay, we're going to stay with institutional order flow. Really nice optimal trade entries in here. We have this low to this high right in here. That's your dealing range. The market breaks below those equal lows, scoops up all the sell side liquidity, then the algorithm reprices higher. And again, for completeness sake, you can see those higher time frame levels up here. Okay, so we're in closer proximity to the dollar's discount arrays than we are on euro dollar. So when I see things like that, it gives me the impression that this currency pair could get a little bit more exaggerated on the upside, while this one may get down to its level here and then gyrate and hang around that weekly rejection block. Euro can be allowed to really fly in here and go higher and trade into the 117s. So we're going to see what we get on Sunday's opening and how we trade into Monday. Again, same bias. We're looking for higher euro until proven incorrect. Classic bull flag if you like to look at those types of things. So let's drop out to a daily chart. All right, so let's take a look at the daily chart. On the left-hand side, that's your dollar. And there's our SMT divergence, higher high here, failed lower low. So this is accumulation and strength in euro. And euro has performed over 450 pips since the divergence. All of the signatures I was looking for, I really want you to go back and watch all of the videos from this month and the commentary around euro. Okay, we were focusing on one side of the marketplace. We were looking for specific signatures, how price was going to trade at this old high. And I'll scrub back here so you can see what that old high is here. We wanted to see it just really expand up above this, not just peek ahead above it and then reject. We want to see it really muscle through that, and it did. So one of the things that you're going to find by watching the videos when it's like this, it subconsciously programs your expectations, because you're hearing me say the same things over and over and over again. I'm not flipping the script and trying to say, okay, now we're trading up here and it's going above here and then we're going to look for a turtle soup. Notice there was no mention of things like that. Nothing like that was described. None of my commentary suggested that. We were looking for one direction, higher euro, lower dollar. We wanted to see specific signatures in terms of the magnitude in which it traded and how much of a large range versus small ranges, like when small ranges in here. We wanted to see big ranges, and we saw that as we breached this old high. Those signatures are very important, because if we were to go up above this old high and then trade back down, would that have met the criteria that I was outlining in the video? No. Because if it would have done that, that would have warned me that I'm probably incorrect, and all this is going to be is a short little shallow run below an old low, and then dollar could really tear higher, and this could really start to collapse after taking out this high. But it delivered on an algorithmic premise that I was outlining throughout this entire month. If you don't see the value in following institutional order flow, listening to me when the market is primed to move, we're going to be right. Okay, I'm not going to be perfect, but we're going to be right. When it's uncertain, okay, you month 2 folks, getting ready to roll over to month 3 soon here in a couple more days, I want you to think about how it was a couple weeks ago when I said it's uncertain, we have to wait for more information. Then when it gets easy, you'll know, and I'll tell you where I think the market's going to go, and it will deliver. This is that example I'm talking about. We're going to have periods where the tools themselves are not going to be that clear. Or let me say it this way. The human in me will not be able to see the things I want to see, and I'm going to have to wait for more information. Now that you have that experience behind you, the folks that are charter members or have been with me for over a year, you're familiar with this. We have periods where you have to wait. And this is why mentorship on a long time frame is crucial, because anyone can get lucky, look really good on a day or a week or maybe even a month, and you walk away with a false sense of security, feeling like you know something. You have to see a calendar year. And the folks that have been with me since August of 2016, you're coming up on 4 years with me. And that's incredible when you think about it. I had to count with my fingers just now. Yeah, so August, that will be a full 4 years. That's like a college degree now. See that? Now you get ready to work on your MBA. So we're looking for 1670 on the upside. I don't want to talk too much to make this video too long, but 1670 is next short-term objective. And then if we get any kind of continuation on the upside on euro, we're watching that 1750, we'll call it, weekly rejection. Beautiful delivery on the daily on dollar. Nice big candles as we drop lower. As we broke through this low here, big acceleration, magnitude, big displacement, big candles. And that's what we wanted to see. We had that. And it's just a beautiful display of following a plan, following a narrative, looking for specific things that deliver like pinpoint accuracy. All throughout this move, I want you to study this weekend on your own. Okay, you don't need to be sending me any charts because I have too many emails to go through anyway. If you have questions that you end up seeing rise up because you're going to study this portion of price action, write down your questions or your concerns or your observations in your study journal. And I want you to really appreciate how many things in this swing here, from this last up close candle to where we are here on Friday's close. Count how many times it created a selling opportunity, working from the daily, the 4 hour, which we don't do too much discussion of, the 1 hour, the 15-minute time frame, and the 5-minute chart and 1-minute chart. Count how many times you see it trade to a bearish breaker. Before it runs lower, look for how many times it runs above a short-term high and then turtle soups and breaks lower. Count how many times it trades to a premium fair value gap, or in other words, a SIBI. Count how many times it trades to a consequent encroachment of a gap. Count how many times you have that opportunity to get short, and how many times did it offer 10, 15, 20 pips or more. There's a lot of opportunity in here for you to mine a lot of experience based on something that I outlined before it happened. We will be moving into another period, I don't know when, but we'll move into another period where everything slows down, and it'll be like this area in here. And when it's like that, you have to be patient. So many people come in, and well, when I was taking monthly enrollments, it was like clockwork. Whenever I had the largest influx of people coming in, it was when we were in periods like this. And when it's quiet like that, they're like, okay, I'm not really seeing what I want to see, and they throw in the towel and they quit. And they're not here when it's like this. And it's really sad because as a mentor, the teacher in me wants to see all of you succeed. But I know human nature, it is what it is. And usually when we see moves like this, and all the excitement and the chatter on Twitter, and everybody high-fiving each other, it makes them want to come back. And usually it's them trying to come back when they can't because they've missed their payment window and you can't restore your account. So I just want you to think about, you've seen in the last 3 months the ebb and flow of how the markets move from a consolidation to an expansion, and we do not change gears. We stay with an underlying narrative. By doing that, you give yourself a far better chance to succeed. And it doesn't mean you're not going to have a loss. It doesn't mean you're not going to miss opportunities or trades or entries. It just means that you're not going to argue with yourself with an internal dialogue about, should I be buying? Should I be selling? If you're feeling that in your month 2 right now, that's normal. That's why I talk to you in these weekly and midweek reviews, trying to keep your focus on the higher time frame premise. If you arm wrestle me in these instances, okay, and I've had so many people try to do this in the past, you're hurting your development. And it's not me showing my ego or saying that you can't be right and I'm going to be always right and I'm never going to be wrong. That's not how you should be interpreting what I just said. By sticking with an underlying narrative, even if I get it wrong, okay, this is important. If I get it wrong, I have the experience to know when to change gears and go the other direction. And therein lies a lesson that you would have not gotten from really any experience, except for you just fuddling around and then boom, you get it, and maybe you won't have the confidence that I would generally usually have if I see something underlying in the marketplace that would change my gears about being bullish or bearish. I don't flip-flop around. And that's the character trademark of someone that's seasoned. You will get just like that. It will become a developmental characteristic that you will grow to appreciate. And that's what mentorship does. Unless you see at least a minimum of 1 full calendar year under my wing and talking about what the market's going to do, likely to do, you're not going to appreciate it. You're not going to see the things that you should be seeing. Just watching static videos doesn't do it. You have to listen to these boring parts of the video because that's where the insight is. That's where the real thing that makes you consistently, efficiently profitable. Period. There's no way other around it. There's no shortcut to it. There's no replacement theory. There's no crutch, no tool, no indicator, nothing except for just being here and listening and then following along and not being in a rush to chase profit with money. Take that part out of the equation while you're here. Because once you understand what you're doing, that part becomes exceedingly easy. Okay? It's easy. Far easier than you can imagine. But there are so many obstacles that's going to be in front of you that's going to impede your ability to be profitable because you're trying to do the wrong things at the wrong time or trying to do things that it's not time to do anything at all but sit still. And that comes by having a strong mentor. Someone that knows how to navigate, knows what they're doing, knows what's likely to occur, and has not 6 months or a year or 2 years of experience. I'm not going to say any more than that. And we're going to look at now cable, and then we'll wrap this video up. Now, I've been quiet about this pair, and I explained to you why. But we have almost delivered today above the short-term high, and again, right in here, that little fair value gap and then bearish order block. Let me just put a little eyeball there. That way it's there. So I'm looking here. Okay. I think that over the coming weeks, we could see it trade up to there. And how we trade there is going to be crucial in terms of, do we go above this high here, or we just come here and then have a pretty meaningful sell-off, and then the dollar might come raging back to some degree. But I'm not going to take these lines off because I need them for another discussion with y'all. But you can see we've had a really nice reaction here, trading up, back down in, optimal trade entry in here, and the price has been delivering. So it doesn't make any sense whatsoever to be where it's at now in reverse. None whatsoever. Because we've already operated on this breaker here and moved away nice. So it's inside that breaker again, but I'm not looking at like a reclaimed PD array. I'm looking at it's going to likely trade above that and reach into it deeper. So let's drop into an hourly chart, work our way backwards. Okay, again, sell side liquidity in here. Price breaks down, clears that, and then we have a market run above relative equal highs. Okay, so a lot of buy side liquidity resting in here. Market runs above that, and now we have buy side liquidity resting above here. And finally working into a 15-minute time frame. Here's the New York kill zone. Optimal trade entry. Boom. Takes off. We have another optimal trade entry in here as well. This here completes at 9:30. That's a really nice one. To me, that's really good because you're inside of a breaker. Before I point it out, find the breaker on your chart. Pause the video if you need more time. Okay. We have a low, the high, and all these lows in here, because we're looking at a 15-minute time frame. If I would have showed this on like an hourly chart or something like that higher, it would be this move here, here, and down in. But it's this framework: low, high. So the last up close candle right in here, extend that out in time, bam. So we're inside optimal trade entry and bullish breaker. For your notes, okay, if you ever get an optimal trade entry that's bullish inside of a bullish breaker and time of day, man, you have a easy buy. Very, very easy. That's something you can go back and look in your charts and study. It's something that will show at least once or twice a week. And those two combinations, well, I guess it's what would be three things. Time of day, which is, a no-brainer. But a bullish breaker with a bullish optimal trade entry. And obviously, everything I just said here can be reversed. If you have a bearish breaker with a bearish optimal trade entry, they're just really easy patterns. And they're things that I cut my teeth on when I started looking for just raw price action. I would look for just those things. And as I was working with them, I'd discover more signatures, more things that would overlap. And you're going to see how they fit together like a beautiful dovetail. Just blends perfectly. It makes perfect sense as to why you're doing it, what you're looking for. Because there's no high here, broken, come back in, find support. Because this is resistance, right? That's what retail says. It's broken here. Does it come back down and give us a buy? No. Inside that last up close candle, that's your narrative. Extend that out in time. Bam. This is where your optimal trade entry is going to be. We're going to look at a 5-minute chart on this in a moment, but just a brilliant short-term reoccurring pattern that occurs all the time. Breaker plus optimal trade entry. It's just an easy ATM machine. Period. End of story. Done. Easy. But you have to train your eye to see it. Some of them are actually way cleaner looking than this one, but this one's still nonetheless, it's nice. But let's drop down into a 5-minute chart. And right away you can see it right there. Fair value gap. Buys of the candles. Look what they're doing. Forget the tails, okay? All this stuff, these are all red herrings, these tails in the bottom of the candles. This right here, that candle and that candle creates that fair value gap right there. It's respecting that closure. Look at the bodies of the candle, folks. I mean, this, when I started seeing this back in the 90s, okay, I literally was giddy. Like, I'm looking around the room like, it can't be this easy. Like, it can't be this easy. There's no way this is happening all the time like this. But yet it is. And this is what I teach you. I didn't make this chart look like this. If you go on TradingView and pull up the chart, this is what you're going to see too. So why is it, okay? Why is it that all the harmonic traders, all the supply and demand traders, all the Elliott wave traders, all the support and resistance traders, all the DOM market profile, why is it that all of these different approaches, okay, if it was buying and selling pressure, how could it possibly manage to create and paint the candles bodies that react where I'm telling you it goes? It wouldn't happen, folks. That would not happen. You're asking for lightning to strike 17 times in the same spot. That's about the same odds you're going to be asking for these things to repeat over and over and over again. It doesn't work like that because the algorithm is in control. The broker is allowed to spread with the tails and the wicks on the candle. That's just part of the business. But the bulk of the volume you're going to see is the bodies. Okay, so how do you use that information? Well, when you're looking at an optimal trade entry like this, I'm not pulling a fib. That's not what I'm pulling. See, everybody on Instagram, everyone on Twitter, all these people, every time I show an example with a fib on there, they're like, I was watching somebody on Instagram, they're saying, oh yeah, you drew your fib wrong, it's upside down. Look, it's amusing because these folks have no idea. We're not looking at a fib, okay, to get in. The fair value gap in the bullish order block with the market retracing lower than 50% of the dealing range, this low and this high. That's the criteria. The fib just helps me frame the idea for you to learn. And then you use the standard deviations projected higher to appreciate where the market may reach for as targets. But they, by themselves, are useless unless there is a premium, in this example, a premium array that would overlap with that standard deviation. Oh. So it's amusing when people see me put things on a chart. It's for you to appreciate because you're used to how I'm teaching and you understand what I'm saying. Not look at this fib. We're going to buy a Fibonacci 62% retracement level. That's an ideal consistent entry approach that's below 50 when you're looking to be a buyer in a discount market. But we're not Fibonacci traders. Okay, that's not what we are. Fibonacci is not the secret. It's the framework that I use to help teach something that would otherwise be hard to grasp for a new trader. Now, obviously, month 6, 7, and 8 in that area, you don't, at that time, I don't think you really need to see a Fibonacci on your chart because you'll be able to see it visually. But just for completeness sake, let's throw it on here. Here's the low and the high right there. So we have the fair value gap laying right on the 62% retracement level, and then bam. It's not the fib that's making this happen. It's the fair value gap, bullish order block, market structure, and its underlying bullishness and bearishness on dollar. See the difference? Now, when you have this type of price action, you can look for higher prices and look for premium arrays. That means basically upside targets. And let me scrunch this up a little bit. Between 1 and 1.5 standard deviation, as I mentioned on, I think I talked about this right after making the video for video 1 on the Optimal Trade Entry Pattern Recognition series on my YouTube channel. You see standard deviations like this. You can split these deviations in half and create additional levels, or you can just visually see them without having to have the line there. Like between this level here and this level here, you can eyeball rough. That's about the midpoint right there. It doesn't have to be perfect, okay? But when I'm looking at these movements here, like I'm looking at this, and then all I'm doing really is just counting what would be a rough approximation of where the standard deviations would be, and visually where they would be split in half. And then all I'm doing after doing that is I'm looking over in the price structure over here where it would match up with something on a higher time frame or the time frame I'm looking at here, and it'll overlap. So when it does that, that's my targets. So I have a high probability target. It doesn't mean it'll go there and stop. There's other things for that, like model number 5 when you get into charter membership. But when you get into market studies like price action model 5, that's like market wizardry, real market wizardry. Like you're really seeing turning points that I just don't go over in the discussions because you're all going through core content and you may drop off, and I'm not wasting that gold on individuals that aren't going to stick with it. You can see how it delivered basically halfway between 1 and 1.5 standard deviation. Bodies of the candle right here. And I'll just give you the real level. You can see it. There we are. So 128 and 1 pip. Okay, so 128 and 1 pip. What's the close on this particular candle here? 128 and 2. Okay, so it's real close, folks. But how do you get to that? Well, you have relative equal highs here, and the highest high on that candle comes in at 127.95. So the high could be 10 pips above that. In this case would be what? 128.05. Okay, 128.05. Well, the high on this candle comes in at 128.03 and 5 pipettes. So within 5 pips, folks, that's where you can get your highs and lows. But it has to be combined with time of day and other things. So, but you can see how all this stuff starts to flesh together, and it's just really a fun way of looking at price action. It's not overly complicated because we're staying with one side of the marketplace. We're waiting for a particular time of the day, New York Open. Okay, and if you're bullish, you're just waiting for a fair value gap to form, or if there's relative equal lows, wait for it to run below that and take the stops, because that's not a break in market structure that's going to send you lower. That's what you would be looking for as a entry. If you don't see a fair value gap, here's something else for your notes. If you don't have a fair value gap, you're probably going to run below a short-term low. But if you do have a fair value gap inside this kill zone, if you will, you're most likely going to be just giving an optimal trade entry and not running below no low. He just answered it. He just answered it. Yeah, I did. How do you know, Michael, if it's going to be an optimal trade entry or if it's going to be a turtle soup buy? The fair value gap. If you don't have a fair value gap, then it's probably going to be seeking sell-side liquidity when you're bullish. But if you do have a fair value gap, you're going to have to trust the fact that this impulse right here, all it's going to do is feed right back down into that and rebalance that. It could overshoot it a little bit, like you've seen here on the tails of the candles. That's normal. Don't try to get so worked up about that. Now, what that generally will hurt is the individuals that want to have a really, really tight stop loss and use the very, very low of that. And it could spread down a little bit, and the spread will open up and get you, especially if it's a live account with a brokerage firm. They'll whip it down in there and gather you because they can see your orders because you're inside of their liquidity pool. In-house brokerage liquidity, they cannibalize the customers. That's why you have to be a little bit more generous with your stop losses. You don't buy into this stuff you see people on YouTube or Twitter or Instagram or anything like that, Facebook. Yeah, I'm trading with a 2-pip stop loss. Yeah, I'm trading with a 5-pip stop loss. I don't trade with a 5-pip stop loss. It's just the brokers are going to open the spread. Now, they're not going to open at 20 on me, but they can open it up 7 pips. Okay, and I'm stuck. I'm going to get wiped out. So be aware that even though that this is where we're looking to be a buyer because of the fair value gap, the market structure is bullish. We're looking for a lower dollar, time of day. Okay, the criteria is there to be a buyer. Okay, and you can see it on a 1-minute chart. You can see one in here. Fair value gap closes it in. You can be a buyer there. This low to this high. Fair value gap right in here. Look at the bodies, respecting it. It has a tail that goes lower, and you're using this low here, and you're trying to be ultra tight with your stop losses. These types of moves here could wick into you, and then you're out, and you missed a move. So you got to be a little bit more generous, and it's okay to have a 20-pip stop or a 15-pip stop if you're using a lower time frame 5-minute or 1-minute chart for your practice sessions, or even your trades when you go to move to live trading. Be generous with your stop loss. Don't try to be ultra tight with your stop loss, because that is something that you're going to really create a bad habit, because you're training yourself to have extremely tight stop losses, which means you're probably over leveraging because you're looking for a way to get the maximum amount of position on your trade and still have a tight stop loss and still be able to trade with 2%, and you're going to find your trades get stopped out a lot. If you look at all my examples I show, you can see I'm not in a hurry to move that stop loss, because as soon as I move that stop loss, it becomes something to worry about. Oh, yeah. I'm not worried about that stop loss. It's there to do its job, period. If it goes there, I'm wrong. If it starts to go there, I'm generally going to see I'm probably wrong anyway, and I'll be able to say the stop most times. But if I get stopped out, I get stopped out. It's not changing anything. It's not diminishing this method of trading, because this is the market. So I'm not worried about getting stopped out. I'm not worried about having an ultra tight stop loss. I'm giving my trade a real chance to breathe. If you strangle it or choke it out, well, you're going to get frustrated. Just as well as I was in the first couple of years when I was trying to learn rules and engagement with risk management. Where do I put my stop? When do I move my stop? The best is scale out and keep your stop in the grades of what I teach in the charter member. That process of when we move the stop, how much do we move the stop, that is always a constant. And if you follow those rules, you're guaranteed you're going to get a losing trade sometime. I'm guaranteeing you it's going to happen. But I'm also guaranteeing that you should see more positive than the few negatives that you're going to incur, because you're going to lose money. No matter how you slice it, you're going to be trading with live funds, you're going to lose money. But if you don't give your trades a chance to move and not come back on you with just normal static, I mean, this is normal, okay? You can expect that to happen. And if you listen to what I'm saying to you, every time we talk about this, when I'm talking about the candles, wicks, and tails, I'm programming you subconsciously to do what I'm explaining you should be doing all the time in your trades or your practice sessions. Give your trade more room than you probably felt more inclined to do initially. In other words, if you want to put your stop loss just 1 pip below here, put it 7 or 8 pips below that. and try to train yourself to do that. And guess what? It probably means you can't trade with a full mini lot. It might have to drop you down into 7 micros. Who cares? Who cares? Because you're not going to stay at 7 micros forever. If you do the right things, it's not going to be like that forever. But it will never change unless you have a willingness to allow the trade to breathe. And it's okay for it to come real close to that low. And if you're 8 or 7 pips below that, then you probably got a good chance. But if it goes down below that low, you're probably wrong. And you might be able to save the stop also. So all those things come with experience. And I don't know where I got in that conversation, but you just got something extra for no charge. So anyway, I will touch base with you all on Monday. Have yourself a pleasant weekend. Relax, rest. And I'm going to try to do the same thing. I'll catch up with you on Twitter on Monday morning. Enjoy your weekend.